Hey, this is Jeffrey with another edition of Stock Smart, the March 19th, 2021 edition. Hope you're all doing well. So it's finally here, March Madness, the day everyone's been waiting for since we missed it last year. Win or go home. It's the second Super Bowl for gamblers. There's over 60 plus games they can bet on over the next 3 weeks with a ton of high-end drama. Illinois, I told you, is my pick. And former President Barack Obama, he has Illinois in the final, but he is going with Gonzaga. Now remember, when you watch this, because we love to get into the stats and numbers, that's what I do, that's my background. Expect a 12-5 seed upset. Stats show 30 out of the last 35 years, 12 seed has beaten a 5 seed. So who's it going to be this year? Let's take a look quickly at the 12-5 matchups, because these are fun. This happens every year. 12-5, Winthrop is the 12 versus Villanova. We have Oregon State, Tennessee, Georgetown, Colorado, and UCSB, Creighton. Now, I got to tell you, I did not watch a ton of college basketball. My team that I follow is DePaul. They were terrible this year. They didn't even have a game. They missed almost all their games at the beginning of the year because of COVID. It wasn't a great start. I think the Big Ten is the strongest, conference by far. And so to me, the upset that I would pick in the 12-5, just because I don't think the Big East is that great, is Georgetown, Colorado. I'm going to take Colorado in the upset of the 12-5. So we'll watch that. There's going to be one. There almost always is a 12-5. Not so much as the 13-4. It only happens 20% of the time, but the 35% of the time or so, the 12-5 happens. NFL announced a new set of national TV deals on Thursday. So they're keeping games on ESPN, ABC, of course. Fox, CBS, NBC, Amazon, and NFL Network are going to have games. And the agreement keeps Sunday afternoon games will be on CBS and Fox. The big deal is Amazon's going to be the exclusive home now for the Thursday night games. So you can watch it on your Amazon Prime, which is pretty cool. And they do a good job covering it. So that's happening. Big announcement for, again, sports gambling and gaming. We're following this closely because it's very tied to the market that's going to probably grow. And this sector is probably going to grow 5x in the next 5 years as more states looked at it. So Connecticut, their online sports betting, they've made through a major hurdle. And they announced a deal that will allow the Foxwood casino operator to launch statewide mobile iGaming for sports betting in Connecticut. You're going to see this more and more as more states look to raise revenue. And they're sick of seeing the money go out the door to Las Vegas, Atlantic City, Indian reservations. They're sick of seeing it. So what they're going to see now is they want to be partners. They want to get that revenue. They need that revenue to continue to build and produce great things in their communities. So you're going to see more and more, and I would guarantee, and I'd make a good bet that all 50 states will have some kind of legislation that allows for gambling. People want it. It's entertainment. It's part of the entertainment profile. Of course, there has to be good knowledge about the gambling problems, and there'll be programs that happen because of that. This is a time, too, if you go into sort of a high inflationary period, where gambling is going to be kind of recession-proof. Because people don't get rid of their vices. They don't. They continue to drink, have fun. They travel a little bit, maybe a little less than normal, but they continue to do the things that they like to do. I want to look at stock now. There's no marketing language on these stocks because, there's no marketing language on bonds. And I want to look at two stocks that are perfectly, I would say, negatively correlated instead of positively correlated. Like we talked about on the show a couple times, many times actually, how the S&P 500 is now positively correlated at least 70% of the time with Bitcoin. Well, this one's a perfect inverse. We have the TLT, which is the 20-year long-term bonds, against the TBF, which is the short or the inverse of the 20-year bonds. So, of course, it's going to be perfectly inversely correlated. And let's look what happens. Let's look what's happened in the last, 3 months here. So the TLT, which tracks the long-term bonds, and you know what's happening, right? What's happening with the long-term bonds? They're being sold. Because as interest rates, the yields rise, that means that the older bonds become less valuable. And they're like, why am I holding this bond that has no yield? Now the new yields are better, so let's get rid of them. And also inflation. When you have a fixed income type security, like a bond, it doesn't increase with inflation unless it's a treasury inflation protected security. Otherwise, a bond just sits there with its yield that you paid for it forever, and then you have inflation and the bond becomes less valuable. You have a dwindling value of money. So let's look at these two. The TLT year to date is down 15%. So the TBF, which is the inverse, right, means the opposite. What do you think that's up? That's up 15%. So one way to maybe hedge, if you believe, and I'm not going to recommend anyone do anything with a short because it's essentially a short. It's not a dramatic short because the movement on bonds is so slow. it is like tortoise. It's not like GameStop, which is like a rocket ship. So GameStop in a short is like a rocket ship. A bond short is like a tortoise, moves very slow. But what you can see here is if you believe that inflation, and we're going to continue to get inflation, I am a firm believer that we are going to see more inflation. I don't think the numbers are accurate. I think the way that they are looking at the CPI right now, doing online and phone polling, is not as good as if you go in person. It just isn't. We've all done it. You know that your Zoom meetings, they do not have the same impact as if you and you go in a meeting and in person and create a connection. So when they go and they start doing these CPI numbers again and they go in person, and I talk to my friends, they have businesses. And I'm like, and they have, a couple of them have like plumbing companies. And they tell me, like, are your parts going up that you're using? Yeah. I'm like, did you pass along increases yet to your consumer? No, we're thinking about it. It's happening too quick. And people are still in this hangover of COVID where they haven't really adjusted to it yet. You know, they're thinking about, hey, getting the vaccine. They're thinking, with my money coming in, I'm getting a stimulus check. They're not thinking about how these prices have gone up, but they have gone up dramatically. Not just energy, in everyday consumer goods. We talked about this commodities being a great hedge right now against inflation because the raw goods and materials that you pay for things that are produced, right? So you have like the corn and wheat and whatever that goes into breads and goes to cows and feed and grain and cattle, and it all goes down the line. Your milk goes up, your beef goes up, steak goes up. All these products that are made, they go up. We talked about how the metals have increased, lumber's increased, so that increases in your house. We talked about the shortage in semiconductors. That impacts your car prices. Then you have interest rates on top of that. Cars are going to get triple expensive. Cost of goods that make the car, plus the interest rate to buy the car, going up. So anyway, if you want to look at possible hedge against inflation, you could play this TBF, which again is up 15.27% this year in a very short period of time, like 7 weeks. That's not 7 weeks, it's about 9 weeks. So up in about 9 weeks, this is up. And it is kind of an inflation hedge. So take a look at it, the TBF. Now we're going to take a question. Let's take a question from John.
The average
so this again
investor
kind of follows what we've been talking about. John wants to know when it's going to be safe to get into tech stocks. Well, this is a tough question, right? Because it doesn't seem safe yet, and it seems like the NASDAQ continues to get pounded. And it does because of the fear of inflation. So when you look at growth companies that don't really make a profit right now, or bottom line profit, you're paying way out in advance, 5 years sometimes, for profits, down the road. And those profits get way more expensive because these companies have to borrow money to keep going. And the cost of borrowing money increases, thereby making their profits decrease in the future. Let's look at a couple of things that really impact this, though. So banks are getting hit a little bit today. And they're getting crushed because the Fed said the SLR supplemental leverage ratio, which they relaxed during COVID, is not going to be extended. It's kind of a surprise. It's going to end on March 31st. But it impacts banks greatly because what it does is they were able to withhold certain things as their leverage notes, meaning they have to have certain deposit requirements on hand to be able to loan more money. And banks make money loaning money. Let's look at really quickly, how do banks make money? It's really simple. It's just like a store that buys a pencil for 10 cents and then they charge you 20 cents when you buy it. The bank does the same thing. They borrow money at X, a lot of times from the Fed, and they want to make a spread. The spread's the difference between what they borrowed it for and what they can sell it for, or what they loan you the money for. Spreads and interest rates are going up, but the move in banks has been insane. The XLF, which is the financial sector ETF, has moved about 16% in 2.5 months. That is an insane move. That move is too great. Many of these banks, JP Morgan, Goldman Sachs, they're up 30, 40% already. And they're anticipating, interest rates moving higher, but the move is too great. And what you're going to see, so the timing of this is what I'm seeing, this is what I'm feeling. You're already seeing some pushback in the banks. You're going to see more, by the way. And also, I want to tell you what's going to happen. Banks hold a lot of 5-year notes. And so you're going to see more selling in notes and treasuries now because the banks now can't use this. They have to count their bonds now in that leverage ratio. So they're going to get rid of them because they're going to want to be more liquid. So watch for more selling of bonds. That already happened this morning when this note came out about the SLR being lifted. We started selling, bond prices in the 5-year notes went up as net selling went up as well. So when interest rates are higher, banks make more money, but this move was too much too soon. So what I would think, here we're going to get into bank earnings April 15th. Some of the big boys, JP Morgan, Goldman Sachs, start that week. Bank earnings usually are the first of the earnings season. And what happens is you're going to get a rotation probably right before that out of these banks, because they're not going to want to sit in there and have disappointing earnings. And I think the banks are going to disappoint based on what they've done. And you saw this in tech stocks. All the tech stocks that even had great numbers, and the banks will not have the great numbers that tech stocks had, growth of 30, 40%. You're not going to see that in these banks. No way. They're going to disappoint in earnings, these banks, when they hit in April. So people are going to get out of them before. And when they disappoint, there's going to be a rotation to the tech stocks. Now, one thing you need to remember, the financials, things like energy and financials, they're not a big part of the S&P 500 anymore. I mean, they are in general, meaning they are a big part of it, but not like the tech stocks, which are like 25, 30% of the S&P 500. And so the incremental moves that you see in the stock prices in like a tech stock, you need big movements to really make a stock price move by $1, because the market caps are jumbos. We're talking about trillion-dollar companies like Apple and Tesla. So the market caps, they need a lot of money in them to move them. When you see some stocks that have smaller market caps, a lot of these banks, especially regional banks, it doesn't take a lot to move them. It doesn't take a lot to move the stock price. So keep that in mind. That's why these have moved so much. And so it seems like it's way overdone. It takes a lot more money to move the big, heavy tech stocks. So timing-wise, I think if people are going to move into these, you see it right into earnings. So like right before, so I'd say early April, that's probably one you want to start taking little positions again or adding to your positions in tech stocks. And that's probably when you're going to see money move out of these financials. So hey, thanks for the questions. Another great show. We did get great news. I was checking last night stats of the show. We tripled our daily download rate in like the last week. And it's incredible. Thanks to all the listeners. Appreciate it. We'll see you again next time on Stock Smart.